How's it going? My name is Jonathan Zaragoza, and today I'll be presenting the FMS Securities Part A case. The first question asks, why is the T-bond return in Table 1 shown to be independent of the state of the economy? And the reason why the T-bill's return of 3% is not dependent on the state of the economy is because regardless of how the market or the economy is performing at the time, all bills must be redeemed at par value. And the second part of this question asks, is the return on a one-year bond risk-free? And although T-bonds are a safe investment because they are backed by the government and very highly unlikely to default, there is still some risk associated with these securities. For instance, if inflation occurs at any point, the expected return is not guaranteed. Moving on to question 2, the question asked us to calculate the expected rate of return on each of the 4 alternatives. For the weighted return, or the expected return for the T-bonds is 3%. For Entergy, we got 7.5%. For Freeport, we got 5.9%. And for the S&P 500 index, we got 9%. If we're basing our investments solely on the expected returns, the best investments would be the S&P 500 index, as well as Freeport. Moving on to question 3. It asks us to calculate the deviations and coefficients of variation of returns for the 4 alternatives. Essentially, the standard deviation measures a bond standalone risk. The larger the standard deviation is, the higher the probability that the actual realized returns are far below what we are expected to get as a return. In this case, in my opinion, the coefficient of variation is a better measure in this case due to the fact that it is a relative measure as opposed to an absolute measure, and it also takes into consideration expected returns. In this case, the lowest standard deviation that we got was for Freeport at 5.52%. And like we stated a little bit earlier, the lower the standard deviation, the better it is for us. Essentially, the higher the standard deviation is, the more unlikely we are to get the expected return that we want. Moving on to question number 4 here. We were asked to basically split up our investments with the 50% weighted average on each of these. Essentially, by diversifying our portfolio, we were able to get a slightly lower expected return. However, as you can tell, our standard deviation did decrease somewhat. We have it at 2.07% here. In this case, if we change the weighted averages to 0.75 and 0.25 for Freeport and Entergy, we were able to see that the expected return decreases and the standard deviation increases. If we do the complete opposite and we give a 25% average or weight to the Freeport and the 75% weight to Energy, becomes a more risky investment. Our expected return decreases as well as standard deviation increasing, sort of like this situation here. Moving on to the next part here, we were asked to consider a portfolio consisting of $10,000 in Entergy Corporation and $10,000 in S&P 500 fund. It asks, would this portfolio have the same risk reducing effect as the Freeport McMoran Entergy Corp portfolio considered in question 4? And not necessarily, does not have the same impact. In this case, our expected return does increase. However, our standard deviation increased significantly. Like we said earlier, the higher the standard deviation, the higher probability that 8.25% return we won't get. So the higher the standard deviation, the less likely we are to get the actual return. Alright, like you can tell here, we have a standard deviation of 7.16%, which is relatively high in comparison to the expected return. It's very unlikely that we get that 8.25% return due to the fact that the standard deviation did increase significantly. Moving on, we were asked what would happen to the portfolio's risk if more and more randomly selected stocks were added. The more and more that we add random stocks, essentially what we're doing, we're diversifying our portfolios more and more, causing a decrease in risk. Thus, the standard deviation also increases or decreases, and we're essentially lowering the risk of not getting the expected return that we want. Moving on to part B, we were asked what were the differences between total risk, diversifiable risk, and market risk. Market risk is the likeliness that an investor or investors face a loss in retrospect to the overall performance of the economy, where diversifiable risk is the decrease on the impact of risk through the diversification of a portfolio. Total risk is essentially both of these combined. The implication is clear. Investors should hold well-diversified portfolios rather than holding single stocks. The reason is because we're holding a single stock. If our portfolio or the stock doesn't perform well, our complete portfolio is not performing well. We are going to skip a bit here because we are running short on time. We're going to move on to number 10. It asks us what would happen if we decrease the long-term debt and total assets ratio, and if we would continue on a similar trend moving forward. Essentially, by decreasing the long-term debt and total assets ratio, total risk of the stock would decrease. Due to the fact that the company decreases debt and risk, the beta of the stock will comparatively decrease as well. As we know from previous assignments and the previous slides, paying down debt isn't always necessarily good. In this case, if the company would continue to pay down its debt, the required rate of return would decrease. Essentially, lower risk equals lower returns, where higher risk equals higher returns. Though it is a little bit riskier, the higher the risk class is, the higher our return could be. And that concludes my presentation. Thank you.